Good morning, everyone, and welcome to this panel for discussing ESG in the alternative investment. So during the next 20 minutes, we will start to introduce what ESG means for infrastructure, real estate, and private equity funds. And you know that we will not have enough time with 20 minutes to explore all the opportunities that are linked to that topic. But without any more delay, and thanks to the support of Lada Strelnikova, manager of the European Energy Efficiency Fund at DWS Luxembourg, John Jones, portfolio manager and fund operation at Genesta Nordic Capital, and Fabrice Jeusette, managing director of Apollo Global Management, I propose that we start to deep dive into our discussion. So maybe to start, could you please briefly introduce what ESG means for you? So maybe Fabrice, you can start.
So for us, ESG is a new product line that is supposed to drive some of our new funds in the future, and this is a good way for us to find growth again in our portfolio and meet some of our clients' expectations. So it's supposed to be a good thing.
I like that. It's supposed to be a good thing. No, ESG is everything. It's the most important topic around at the moment, and it's something that we've been doing for 10 years. It started as sustainability, and now it has become, about 3 years ago it became ESG, but it completely has redesigned the way that we work. We don't just have a business plan that monitors risk and reward, but also a carbon plan as well, whose objective is to decrease carbon emission, period.
And maybe for you, Lada?
Okay. I mean, for myself, I think asset management will be probably going, most of asset management will go into ESG criteria or ESG or sustainable investment criteria sooner or later. So that's not the trend. In my view, it is a general condition which will be imposed and coming over and over in the market with more transparency and more clarity what actually we mean and what actually we do, because the investors will just simply ask for it.
So thank you for that introduction. And so as you know, the SFDR, which entered into force more than a year ago, revealed the importance of the transparency of information and of the reporting. But also, the SFDR linked ESG to data for measuring risk, performance, and impact. In that context, ESG data becomes more and more important. And maybe Lada, with the European Energy Efficiency Fund, ESG data was part of the investment strategy. So could you explain how you are monitoring that and reporting that to your investors?
I mean, in the case of the European Energy Efficiency Fund, the investment guidelines have already outlined the criteria of the investments. So it's not like you have the investment portfolio and you have your investment decision and you need to fix an ESG criteria. So it's more clear, and it's more clear in the investment guidelines, what you could do and what you could not do. So this is already defines your portfolio per se, and then in the second step, each investment needs to go through the certain elements of review in respect to environmental, social, and governance risk, and the tangible results that you could report for this kind of project that we are looking at is the primary energy savings and the CO2 savings, which we based on certain calculations which has been aligned with the international protocols we report quarterly for all our projects. I think this is a quantifiable results, and then you have a more qualitative results where you look at the supply chains and you look at the recycling and whether the circular economy is integrated. Which, I mean, you tend to do this, and you tend to disclose, and you need to disclose this information, even if you don't have the full scope of information for each project. We try to disclose as much as possible at the project level.
Thank you, Lada. So we saw that for infrastructure, the approach to ESG is a bit different. And for the private equity, for you, Fabrice, when you are launching a fund at Apollo with consideration of ESG information, all those additional information are collected, monitored at your level?
So when we do private equity fund, by definition, we have a large variety of type of investments. And so it can be very broad in range of the type of business that they are active in. And so by definition, some of these portfolio entities are more, let's say, knowledgeable about ESG and some reporting that could exist. Some don't. And so there is a certain level of collaboration to have with your portfolio entities to explain what are your needs, to also sometimes be very specific in what types of KPI you would need to collect. And so all of that means that there's a lot of investments in terms of time, but also sometimes in terms of money, to be able to put in place the framework to have the right information, and most of all, also getting it at the right moment, because all the data is not easy to collect, specifically if you want to make some calculation of the CO2 emissions or whatever. So that can be time consuming. It brings in some additional costs that are just the data collection, plus the cost of adapting to the new regulations internally, so the new people that we need to have to collect this information, to produce the report, to digest the different rules. So that is also something that we need to take into consideration when we look at the actual metrics of the fund. So it's a I would say a long-term investment, but it needs to have direct returns, which is sometimes a bit hard to find.
Yes, indeed, direct returns, and I will say that in real estate we have the same challenges in data collection, but with additional difficulties maybe linked to the type of building, this renovation plan, and also the multi-stakeholder approach with the tenants and so on. So at Genesta, how do you envisage that?
Yeah, it all starts right from the very first moment that we buy even before we buy the asset. Once we're doing our due diligence, we immediately commence our ESG DD and our taxonomy DD, and from making an assessment of the building, it's quite easy to see how much we have to do in order to be able to capture data. So some of it's quite easy, installing smart meters for energy usage, water, waste, greenhouse gases, other sensors that turn air conditioning off if people aren't in the room, or that flick air conditioning on if there's too much carbon dioxide. That sort of thing, it's quite easy, but then it takes time to build up the data to know whether the initiatives you've implemented are actually saving you money, improving the quality of the building, improving the people's quality of life who work in the building, for example. So what we've, and also we have another issue where we buy a lot of, our funds are all Article 8, where we buy assets that are like energy rating F and G, and to implement these changes, it costs a lot of money, but it generally does have an immediate effect. However, you've got no idea of what it was like before, because a lot of the buildings we buy are either empty, or if they're not empty, we soon give notice and empty them. So then to build up that track record of data is something completely different, where we have to make assumptions and run a lot of different scenarios to get a general idea of what the building's carbon footprint was previous. So yeah, it's very interesting. There's no right answer, there's no wrong answer. There's just lots of yeah buts in the conclusions. Yeah.
And maybe because there are a lot of type of data that can be collected, and how do you see the SFDR with the principal adverse impact and also maybe the EU taxonomy as an help, support, or an additional obligation that is different from your investment ambition?
All of the above. I mean, we do a taxonomy DD when we buy an asset, and basically the world isn't set up for taxonomy yet, so we get told the answers that we want to hear. However, at least that way we've got a bench line that we can work towards, like air tightness. Who measures air tightness? But it has to be measured, right? Also, with like the principal adverse impacts, at least that way we can choose one or two, like one, decrease, you know, improve the carbon footprint, or, you know, decrease energy usage. Another could be improve social aspects of the building, something like, or social well-being of the people that work in the building. So that way we've actually got targets that we can work towards. Now, whether you need a law to tell you to have that target or not is something else. You know, these are things that we're naturally working towards anyway. We started this 10 years ago, before there was a law even cooked up. So therefore, but at least it will develop a standard. At least there'll be a benchmark that technically, after say 5 or 10 years, different funds, different properties, different industries will be, different property types, categories, etc., will be able to compare themselves to see how we are implementing and performing in accordance with our peers in the law, I guess.
And do you have the same, Fabrice, for you for the private equity? So do you envisage principal adverse impact? So John mentioned that there is no need for having rules or guidelines to measure impact, but do you think that it's additional burdens or something that it's helping you to design your Article 9 funds?
So what is interesting is the fact that when we talk about private equity investment, at least within Apollo, we didn't wait for the new regulation to have some investments that can qualify now for an SFDR ESG type of thing. So we're not making new type of investments, we're just having a new framework. And so de facto it will have, and it has an impact on how we organize the team, because of course there is way more compliance to be done around it. So that means that we need to reorganize a little bit the way that we are teaming up to assess those funds and to drive them. But definitely, I mean, all of that is changing and something in movement for the moment, so yes.
And also, so we understood that there are a lot of challenges, of course, linked to that, but also a lot of uncertainties, because so ESG has been already integrated since many years at your organization, but market is evolving with institutional and retail investor demands that could also evolve. And how do you perceive those uncertainties to make sure that your products are recognized by the market as being sustainable investments? Or you see the link between financial and ESG performance as well linked to that on the long run, and what could be at the end the cost benefits of your product? So maybe John, do you have an idea on this?
How we will get the market to recognise it is through a standardisation like a BREEAM certificate or the GRESB Gold Star. That's ultimately it's an independent recognition about where we are at and how we are performing. What is also driving us is our investors as well. Like, you've got an Article 9 fund. We have investors that want us to become Article 9, but our attitude has always been, whoa, let's just wait until there's further guidance on this, because it could be very difficult to build up a portfolio of disparate assets in different countries and different cities and make it Article 9. But it's also our investors and their recognition. They need information to report back to their shareholders, although in the case of us, all of our investors are pension funds, so back to their pension holders to demonstrate that action is actually being taken.
And for you, Lada, with 12 years of the European Energy Efficiency Fund, so you have enough view about how ESG performance evolves against financial performance. How is it provided as an information to your investor, and how they perceive this ESG versus financial performance?
I mean, there are no, I would say the financial performance is not better because it's SFDR Article 9. So that has nothing to do with this one. I mean, I think the investors, and that's what we'll be on, they require the transparency about what this SFDR 9 product is actually doing. And since we don't have the standards yet, we don't know any kind of, I would say, benchmark. As you were saying, it's still difficult. So you need, in each case, you need to prove to investor that's what I'm doing as a sustainable investment product, and it's following the SFDR. So now when the disclosures are coming, and we'll be having more disclosures now coming from end of this year, then we disclose more information than what we have done before. So it is definitely challenging for us, even for us, if you will see on the not doing any significant harm. And I mean, we could not claim that even our projects are net zero, because they still consume electricity, and electricity comes from the grid, and it has a coal component. So, of course, there will still be projects doing harm, and I think, whether it will not be significant harm, but it's still harm because it's using electricity, or it is still partly using natural gas for whatever, for the backup period when the biomass plant is not operating. There are a lot of aspects, I would say, that will be coming into this interaction. And then the investor is saying, okay, I do accept this is a SFDR product, or I say, no, I don't think that I don't feel like that. It's what information that you disclose. And I think more this disclosure agreements coming, I think then more transparent the industry becomes. So it's not only on alternative assets, but also on the mutual funds as well, in my view.
Yes, indeed. The challenge is everywhere on this financial versus ESG, and even more for you, Fabrice, on the private equity. When you have a classical private equity investment strategy and you put on top of the ESG data, how you envisage that, and how you are communicating also to your investors about this financial return that will be the same than for another fund, but in addition measuring impact through ESG.
So, exactly. So for the moment, what we do is that we say our impact fund, which is an Article 9 fund, is a private equity fund. And so as such, we don't consider it being very different, meaning that we target the same returns. I think what is interesting, and that we don't know yet, is how the value of an asset will evolve in the future based on its ESG, let's say, characteristics. So to make it clear, one of the moment where you realize a big portion of your gains on the asset is when you dispose it. So the type of investments that we have in our Article 9 funds are supposed to be entities that you buy and that you want to make greener than what they are, or to improve their E or S or G, or all of them at the same time. But value as at now comes from EBITDA, for example. So of course you want to grow the EBITDA, but what we don't know is what will be the market reaction beyond the EBITDA with respect to the ESG metrics and the KPIs you have. So in other words, will there still be some room for them to buy an asset and keep on improving the ESG aspects, or will they just want to have something that is already at the top? So we don't know how it's going to be seen by the market, and if it's going to have a positive impact, or if it could just be negative impact on the pricing, depending on who you want to sell it to.
Can I add, in the case of real estate, So in the case of real estate, again, when you sell your asset, it's whom wants to buy it that is the trigger as to whether your initiatives have worked or not. If it's a big German or Dutch pension fund that wants to buy it, who value these things, then you know that then you'll know that what you've done has worked. And if you're getting a low yield, a high price, then you can make an assumption that it's been all worth it, even though you can't actually quantify it.
So maybe it would be good to meet in 5 years again and to have the same discussion to see how things evolve on this question, financial versus ESG, and how those was marketed correctly and attracting investors definitely. I see that we are running to the end of this panel, and maybe in one sentence, could you please explain what motivates you in ESG? Maybe John?
Well, we only have one planet.
It's true. I think, honestly, for example, I find electric bus more exciting than the diesel bus. Might be quite plain, but...
I think it's really interesting to see that now people are looking at finance and fund industry as a potential real engine to change some of the way of consumption.
Thank you, and I think that what is also good is to see from one year to another the ESG community increasing with a lot of people that would like to dedicate time on this. So thank you, Lada, Fabrice, and John for having shared your insight today on the ESG for the alternative investment. And yes, thank you everyone for having attended this panel discussion.